Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. AI funds are gaining serious attention as more investors look for ways to tap into the explosive growth of artificial intelligence. These funds bundle together stocks of companies leading AI innovation, from chip makers to software giants, offering a simpler path into this fast-moving sector. If you're curious about how AI funds work and whether they fit your portfolio, this guide breaks down the risks, rewards, and best options for 2025. What are artificial intelligence funds? Artificial intelligence funds are specialized investment vehicles designed to give investors exposure to companies shaping the future of AI. Instead of picking individual stocks, these funds bundle together shares of businesses actively developing or using AI, from hardware suppliers to software innovators. Think of them as a shortcut to betting on AI's growth without needing to track every emerging player. How AI funds differ from traditional funds. Most traditional funds spread investments across industries, tech, healthcare, finance, without focusing on specific trends. AI funds, on the other hand, zero in on companies where AI drives either revenue or competitive advantage. They don't just include obvious giants like NVIDIA or Microsoft. Many also target smaller firms pushing boundaries in machine learning, robotics, or data analytics. Key differences include targeted exposure. AI funds prioritize companies directly involved in AI development. Higher volatility. They may swing more sharply than broad market funds due to focus on a fast-moving sector. Rapid evolution. Holdings can change quickly as new startups emerge and tech shifts. Types of companies in AI funds. You'll typically find three categories of businesses in these funds. Tech giants with AI divisions. Companies like Alphabet, Google, and Meta invest billions into AI research. Pure-play AI firms. Startups or public companies like C3.ai or Upstart that rely entirely on AI-driven products. Enablers. Chip makers, e.g. AMD, TSMC, and cloud providers, e.g. AWS, Azure, supplying the infrastructure for AI systems. Key players in the AI fund space. Several ETFs and mutual funds have emerged as leaders. Global X Robotics and AI ETF BOTZ covers robotics and automation alongside AI. ARK Autonomous Tech and Robotics ETF, RKQ, bets on disruptive tech, including AI innovators. iShares Robotics and AI ETF, IRBO, a broader mix of global AI and robotic stocks. Private funds and venture capital also back early-stage AI companies, though these are often limited to institutional or high-net-worth investors. Why invest in AI funds? AI funds aren't just another tech trend. They're a way to invest in the foundational shift happening across entire industries. From healthcare diagnostics to self-driving cars, AI is rewriting how businesses operate. If you're looking for growth, diversification, and a stake in the next wave of innovation, here's why AI funds deserve a closer look. High growth potential. The AI market isn't slowing down. Analysts predict it will grow from $150 billion in 2023 to over $1.5 trillion by 2030, fueled by breakthroughs in generative AI, automation, and big data. Some sectors leading the charge. Healthcare. AI-powered tools like DeepMind's AlphaFold, which predicts protein structures, are accelerating drug discovery. The AI healthcare market alone could hit $188 billion by 2030. Finance. Fraud detection, robo-advisors, and algorithmic trading rely on AI. Companies like Upstart use AI to assess loan risk, boosting approval rates while cutting defaults. Autonomous vehicles. Tesla's self-driving tech and Waymo's robotaxis are just the start. The global autonomous vehicle market may reach $2.3 trillion by 2030 with AI at its core. These aren't hypotheticals. NVIDIA's stock surged over 200% in 2023 thanks to its AI chips, showing how quickly leaders can capitalize on this shift. Diversification benefits. Traditional sector funds, like energy or retail, tie your money to one industry's ups and downs. AI funds spread risk across multiple frontiers while keeping a tight focus on innovation. Here's how they compare. Broader tech exposure. Instead of betting on a single company, you get shares in hardware makers, software developers, and cloud providers, all vital to AI's ecosystem. Future-proofing. AI isn't confined to one industry. It's reshaping everything from farming, precision agriculture, to entertainment. Netflix's recommendation engine. That means your investment grows alongside adoption, less reliance on old sector cycles. While traditional funds hinge on commodity prices or consumer spending, AI funds ride advances in research and adoption, which are less tied to economic swings. Think of it like planting a garden with fast-growing, resilient crops instead of relying on a single type of plant. You're not just betting on tech, you're betting on the future of how all tech works. Risks associated with AI fund investments. AI funds offer exciting growth potential, but they also come with unique risks. Understanding these challenges helps you make informed decisions, not avoid the sector altogether. Let's break down the key risks so you can weigh them against the rewards. Market volatility. The AI sector moves fast, and so do its stock prices. One breakthrough can send shares soaring, while a single setback can trigger sharp drops. For example, NVIDIA's 2022 dip. After years of growth, shares fell nearly 50% in months due to slowing chip demand before rebounding strongly in 2023. AI startup swings. Companies like C3.ai have seen 30% price swings in weeks based on earnings reports or tech updates. This volatility happens because AI is still evolving. Investors react strongly to news about new tech releases like ChatGPT's launch boosting Microsoft. Competition. A rival's better algorithm can shift market share overnight. Funding cycles. Startups may soar after fundraising but struggle to deliver profits. If you invest, expect ups and downs. Spreading investments across multiple AI funds or pairing them with steadier assets can help manage this risk. Regulatory and ethical challenges. Governments and consumers are still figuring out how AI should work. Changing rules and public opinion can shake up the sector. Data privacy laws like Europe's GDPR or California's CCPA force companies to rethink how they train AI models. Tightening rules could raise costs or limit innovation. Bias in AI algorithms has also drawn scrutiny. Flawed systems in hiring or lending tools have led to lawsuits and reputational damage. We've covered the basics of AI funds, but stay tuned for part 2, where we'll dive into the best picks for 2025 and how to evaluate them. See you soon! Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.